As a rule, many money managers tend to steer clear of the real estate investment trusts when interest rates are rising. REITs are dividend stocks, and their payouts become less attractive when bond yields rise dramatically, as we saw today. So what do you do with a high-quality REIT that has a terrific concept? Take CyrusOne, which is a data center real estate investment trust that makes its money operating these huge warehouses full of servers. We know there's a ton of demand for data centers thanks to the rise of the cloud. But on the other hand, CyrusOne sports a 2.9% yield, and that dividend gets a lot less attractive when the benchmark 10-year Treasury is now at 3.15, and the 2-year, 3-year, and 5-year yields hit 10-year highs today. Now, this stock managed to put up a nice rally when the bond market was behaving itself. In the last few weeks, though, CyrusOne has pulled back from 68 to 63 and change, even as the business is doing just fine. So has it been punished enough? Could the company potentially do well enough to outweigh the impact of rising interest rates on its stock price? Let's check in with Gary Watazik. He's the president and CEO of CyrusOne. Find out more about how the company's doing, where it's headed. Mr. Watazik, welcome back to Mad Money. Good to see you, Gary. Thank you so much. Have a seat. Okay, so I was on a conference call with your CFO, and she actually said, look, higher rates are not good for us.
Sure.
And I want you to describe to people what it really does, because I think there's a lot of people who watch the show who would never understand why a growth business would be affected by higher rates.
Well, we're structured as a REIT, and as you point out, it's a digital REIT, so we're focused on serving the needs of the cloud companies. But since 60+% of our investors are real estate investors, we're caught up in that tailwind. So anytime the yields are going up, our stock gets impacted. You saw that now. You saw that earlier in the year. However, the secular trends are so strong, and our underlying growth is really strong, and that's easily the best way to combat the rising interest rates. So maybe they're up 50, 60 basis points. Our top line growth is over 20%, so that's longer term. That'll easily offset any issues associated with rising interest rates.
All right, so Gary, so I speak to a lot of people, and spoke to a lot of people last week who were in San Francisco, and there was this whisper, and I want to put an end to it. The whisper is that the data center is slowing. I don't know where it comes from. I hear it from here. I hear it from there. You're the guy. No. You would know more than anyone. Is it slowing?
Absolutely not. We've come across, ending the first half, having bookings that totaled everything we did in all of last year. So in the first 6 months of this year, we sold everything we did in all of 17, and that was also a really strong year. So from our perspective, it is accelerating. And if you talk to any of the FANG companies or even the broader group, there's about a dozen companies that are really kind of driving this industry. Everyone's capital expenditures are up dramatically. I mean, there was an article in a journal not that long ago with 4 or 5 companies spending over $50 billion in CapEx, equivalent to kind of like what real industrial companies are doing. And that's all because of the demand that they're seeing is enormous, and they're preparing for all that growth.
Okay, so give us some benchmarks that tell people that they shouldn't worry. Length of lease, rising prices of lease, some metrics that clearly indicate that it really is strong.
Yeah, just this last quarter, I mean, we had a $65 million booking quarter, our biggest quarter ever. $100 million of bookings in the first half of this year, more than we did all of last year. So really 2 good indicators. With regard to the number of leases, it was a record number of leases we did, over 500, and the term of the lease was just about 12 years. And if you contrast that to when we IPO'd 5 years ago, I mean, the average term of our lease was like 26 months. So the length of term is going up, the amount of deal size is increasing, and the penetration in terms of the number of different locations each individual customer is buying from us has increased. 60 or 70% of our businesses with customers in more than one location, and 90% of our businesses with repeat customers. So really good indication.
All right, so when someone told me he'll say that, then ask him, why did he expand in Europe if it's not slowing in the U.S.?
Well, actually, the way I look at it is you're really in an inferior position. Data is global, right?
Right.
If your kids play Fortnite, they're playing against kids all around the world, so data is flying around the world. Our customers, which are predominantly Fortune 1000 customers, are deployed everywhere globally. So if you really want to be helpful to the customer's needs, you have to have a global platform, and if you don't, you're really in an inferior position. And we look at all the success that we've had in the States over the last decade, and we feel really comfortable that we'll be able to export that same success internationally, because all the growth internationally is coming from all the customers that we serve here. So what we're doing there, and also with the combination of the GDS acquisition, the partnership that we made with the Chinese companies, the cloud companies coming out of China are equally as ambitious. So we're going to do really well once we start launching.
All right, there's some short selling fund who's saying this GDS overinflates and stuff. I don't know. I mean, But I know you just can't give me like a
Sure.
one-word answer on that, but it sure doesn't seem like it to me.
No, look, I think the best validation of that is market spoke for itself. The guy came out with a short thesis. People had a chance to review what he said. I think the management team did a great job of rallying back, and they're basically at the same price they were prior to the short. It's a great company.
That's what I thought. Now, I got to tell you, maybe what it is people don't believe it can last. And yet, if they don't think it can last, why would it still be accelerating? I mean, if it didn't last, it would be plateauing.
Like, the thing that's really kind of always bothersome to me is that you have all of these other companies, Amazon putting up a 49% quarter. It's a $25 billion company. That's the third sequential quarterly increase of a really large company. Salesforce, Microsoft, Oracle, everyone's putting up big numbers. And there's a disconnect in that while all those companies have done really well and their share prices have exploded over that, you don't get that same follow-on effect in the data center business. And all we are doing is, we're making these digital factories that power those products. So all of that growth that you see there is ultimately going to manifest itself in our growth in our business.
Well, look, I want to thank you for answering what I thought was a specious view, but we put it to rest. Okay, that's Gary Wojtaszek. He's president and CEO of CyrusOne. I don't see any slowing. He doesn't see any slowing. Let's just put a nail in that coffin. Mad Money is back after the break. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.